Good morning, everyone, and heartiest welcome. Thanks for joining in, and that shows your commitment to be a part of the success journey for the upcoming examination. So, because it was the first day, there was some initial setup requirement, and because of which it took time. From tomorrow, we'll start at sharp 5:30. Once again, welcome to everyone. Let's wait for a couple of minutes till others join in. If you are able to hear me, if you are able to see my screen, just give a thumbs up and also let me know from which location have you joined in, your city, your town, your place, wherever you have joined in the comment box. So I'll get an understand to what extent have we reached for this live session. Once again, heartiest welcome, and few things I would like to clarify till the time others join in is this is a fast track live batch. So when we say it's a fast track live batch, it will not be covering everything in detail or every logic or every concept in too much of depth. So here we are trying to cover everything from more of an examination point of view. Yes, wherever needed, I will give you the logical understanding, I will give you the logical reasoning, but I will not be covering everything in too much of depth because that is covered in a full-fledged class which is about 200 to 250 hours, right? And also coming to the questions that would be solved, in a normal class I would solve about 500 plus questions. Here we'll try to cover 100 to 120 questions, important questions. Most of them would be past exam questions and tricky study material questions, right? So that is how we'll be preparing. And there's a WhatsApp group which most of you would have been part of. If you have not joined, you can join it after the session, and notes can be downloaded and from our free resources section, from where you'll get the entire set of notes that we will be using in our classes. Okay, so right, a lot of us have joined in, got a lot of good morning messages. Getting up at 5:30 and turning up itself is a big thing. Now coming to what are we going to do and how are we going to approach this subject. So on the screen you can see that I have put up the past paper analysis from November 20 till May 23 to get an understanding of what questions have been asked and from which chapters have the questions been asked. Now I'll not go line by line because a lot of you already would have had this. If you see the most important or highlighting part, Ind AS 115, one of the longest and tested in almost every attempt for 12 to 15 to 20 marks in some cases. That is one standard where we will have more focus on, because if I am able to secure good number of marks in this standard, then my target of 60 becomes much easier. Okay, and it's a very long standard. If you look at institute's material, it's lengthy, it's complex, but then we will simplify it because 80% of this standard and also other standards that we'll be talking about, they are more logical, they are more understanding based. Okay, there are 10 to 20% part in each standard which are tricky. We'll cover those also. But if you are able to master that 80-90%, the crux of the standard, then there is no need to worry about this. Then coming to the next important part of the testing aspect, if you see, accounting and reporting on financial instrument, every exam 20 marks. Again, this is one standard where a lot of students are scared. Even I as a student was scared. How many of you are scared with this standard, or how many of you feel that this is a very tough standard and this is something which we may not be able to handle well in the examination? We can just say that yes, I am scared of financial instruments. If you are feeling that scare, or if you have that thing or concern about this scaring, you can let us know in the chat box, and we will see that a lot of you are actually afraid of this standard. But again, the basics part, the basic accounting part, including something called as compound financial instrument and all of that, once you understand the steps and process, it will be easy. Yes, in some cases where there is modification and all of that, it may be difficult, but again, if you are able to cover 80-85% of the core of the standard, out of this 20 marks, I can guarantee that 12 to 15 marks you can easily have it in your pocket. That is the second one. Then the third one is business combination and consolidated financial statements. So these again, I would say, once you know the framework, once you know the steps that I will teach you, Out of 20 marks, I can guarantee that 15 to 16 marks will be easily in your pocket, because once you know the framework, how to approach this particular chapter, it will be very, very easy. Okay. A lot of students, what they think is business combination is not important because it is not tested. Only consolidation is important. Don't take it that way, students. Both of them are interrelated to one another. Then comes our next favorite standard, Ind AS 116 on leases. Again, 6 to 10 marks from this is generally tested in each of the examination, barring few exceptions. So if you see revenue, some 15 to 20 marks, leases, let us say 10 marks, that makes it 30 marks. Then business combination and consolidation, 20 marks, and financial instrument, 20 marks. This itself takes care of your 55 to 60 marks of the paper. Sir, are we going only these standards? Are we doing only these standards? No. We will cover all the standards, we will cover all the concepts, but more focus would be on these standards where students face challenges and students find difficulties. Right. Now, what we are going to start today is our standard on leases, Ind AS 116. For some reason, I was not able to connect my iPad today, but still, we will try to cover it using PDF and Excel. We'll cover the standards first, majorly the theory part, and then subsequently we will come to problem solving part of it. Okay. Now, few ground rules. Whenever you have any question, whenever you have any doubt, feel free to put it in the comment section. This analysis can be seen on our note, the entire note. So if you have not downloaded notes, I'll just send you the link of the notes. In fact, if you come down the standard, we have also told exactly what type of question has been asked each attempt. So from November 22 to May 23, classification, PPE held for sale, revenue cumulative catch-up adjustment. So you can actually see here. Ind AS 115, service concession arrangement, sale of machines and spare. Okay. So even the broad type of question has been covered. That okay, this is the type. Like for example, Ind AS 109, subsidized loan to employees. Okay. One of the straightforward and standard question for 14 marks. It is something like a bonus for all of you. So this analysis and the notes, those of you have not downloaded, I am sending across the link in the chat box. After the session or even during the session, you can download this thing. If you are unable to put, I'm getting some WhatsApp message saying that I'm unable to send message in the live stream. You just need to subscribe the channel and then you will be able to add your comments to the live. Okay. Now enough of background. Now time to get into the standard, that is Ind AS 116 on leases. Now, as I told you earlier also, I will not be going into 100% of depth of a particular standard. It would be more like a broad coverage so that we are able to understand the requirements for the examination purpose. Okay. Yes, still if you have doubt, you can ask it here. So even if after that your doubt is not clear, you can make use of our forums where you can ask doubts. Right. So let's start with Ind AS 116, and I have tried to simplify this standard as much as possible as compared to the textbook. I hope we are ready to go. Let's start with this. Now, what is a lease? Whenever we talk about a lease or whenever we hear this term lease, something which strikes our mind is rent. Lease is also something like rent. Okay, but there is a distinction, because rent, you don't say that we will take a hotel room on lease, because that's for a short term period. So rent generally refers or connotes a short term contract, whereas lease is something which talks about long term contract. That is not absolutely necessary for our understanding purpose. Now, as far as Ind AS 116 is concerned, Ind AS 116 does not cover all types of leases. Ind AS 116 defines a lease, and according to that definition, whatever contract falls under Ind AS 116, that is what is covered here. Sir, what if a contract does not fall under Ind AS 116, though it is a type of lease? then in that case we will not call it a lease, because as per Ind AS, lease has to be as per Ind AS 116. All of those would fall under Ind AS 115. Okay, so if a contract does not fall on lease, then you will take that contract to Ind AS 115. So contract is very important. Now, what is a lease? A lease is a contract or a part of contract. So there has to be a contract. Contract means there have to be two parties or three parties, orally agreed, verbally agreed, written documentation, whatever it is, there has to be a contract that conveys the right to control the use. So this is the very important part. It conveys right to control the use, means there is an owner of a property, there is a user of the property. Think of it like I have taken an office building on lease. I am the user of the property. There is a owner of that property. Now that owner of the property has given me the right to control the use. Sir, what is the meaning of this control to use? To control the use means I can decide in that building, within the given parameters, within the given requirements of the contract, how will I use the asset? So if I have that right, how to use the asset, for what purpose to use that asset, or I may think that I will not even use that asset, whatever it is, that is called right to control the use. So the lessee in this case, in the contract of a lease, the lessee, the user, has right to control the use. So what is the meaning of right to control the use? How and for what purpose is decided by the lessee. For example, if I take a car on lease, it is my right to decide whether I want to drive it, whether I want to keep it in my garage, whether I want to take it to Kashmir, whether I want to take it to Northeast, wherever I want to take it. It is my thing. It is my right. I can use it. Now, sometimes a contract may have restrictions that you can take the car anywhere, but you cannot take the car outside India. So within that restriction, I have the right to control the use of an identified asset. Again, very, very important. The asset must be identified. You must be able to tell that, yes, this is the asset that is the subject matter of the lease. This particular floor, this particular flat number is the subject matter of lease. Or this particular specific car with this registration number is the subject matter of lease. So the asset must be identified. A lot of time what happens is, there are contracts. Just a second, I will share one. So today largely we'll manage with Excel. Tomorrow it will be Excel plus some written process. A lot of time what happens is, whenever we are having these type of contracts, what happens is, say there is a mobile connection. Now for mobile connection also you pay monthly rental, but you do not say that this is a lease, because you cannot identify the asset that you are using, because the telephone provider, the service provider, can use any telecom tower, can give you any type of access from whichever satellite, whichever tower they want. So that is not a lease. The asset is not identified. Or a lot of you would be using Google Drive, but that will be on free basis. We use OneDrive on paid basis. Okay, we pay annual rent to Microsoft, and considering that they provide us storage space. Now this also is not an identified contract, because I do not know in which hard disk, in which server is Microsoft storing my data. So in that case, it does not become an identified asset. Sir, in what case it would become identified asset? I tell Microsoft that, boss, my data should be stored in hard disk number 40 at location Delhi. If I am giving this instruction and then I am telling Microsoft, boss, you cannot have any other customer's data in this particular hard disk, in this particular location, in this particular server, then I can say it is an identified asset. Sir, why are we stressing so much on this basic definition part? The reason is that this definition can be tested as a conceptual question. They may ask you a question saying that whether this is an identified asset or not, and accordingly we will see, or we'll have to explain whether it is a lease or not. Now, one important thing that you have to keep in mind is the moment it is not an identified asset, the moment it is not an identified asset, it does not come under Ind AS 116. So then how will we account for it? We will account for it under Ind AS 115 from the supplier point of view, and as an expense from the customer point of view. So contract or a part of contract which gives us right to control the use. So control the use meaning I can decide how to use it of an identified asset. I know the particular asset for a period of time. So this is always for a period of time and in exchange for consideration. Consideration means the user will mostly pay money terms, an amount of money monthly, annually, or on a prepaid basis. They will pay that amount to the lessor. So that is what is the meaning of lease. Then whether a contract is or whether a contract contains a lease or not, that assessment has to be done at the inception of the contract, and subsequently you will not reassess that initial classification. Only if terms and conditions are changed, you will reassess. Otherwise, at the inception of the contract, at the beginning of the contract, you will see whether the contract contains a lease or not. Right? Now, we have understood identified asset broadly. Now, identified asset is either explicitly specified in the contract, means we mention it in the contract that yes, flat number 201, building number this is the asset that is specified in the contract, or implicitly specified at the time it is made available by the user. Now, implicitly specified means that I am not explicitly stated, but let us say the supplier has only one car. The supplier has only one car. Now, if the supplier has only one car and I have entered into a contract for lease of that car, then that car becomes an identified asset. That is the implicitly specified. Now, one important thing for identification is this SSR, not Sushant Singh Rajput, substantive substitution rights. Now, here what we need to understand is if the supplier has SSR. Sir, what is the substantive substitution right? Substantive substitution right means that the vendor or the supplier or the lessor has an ability to substitute the asset whenever it wants and for its own benefit. For example, if we take a car on lease or hire, I would rather call it. Okay. Now, if the supplier has the ability to change the car, whenever it wants, it will send, let's say send Indiga. Whenever it wants, it would send Swift. Whenever it wants, it would send some another car. Whenever it wants, it would send an SUV. The vendor has the right to substitute whenever it wants, and that substitution is giving some kind of benefit to the supplier. So two things: the supplier can change the asset, and that supplier, when it changes the asset, it gives some benefit to the vendor. Okay, so he's getting some kind of economic benefit. Otherwise, nobody would want to change the contract or change the asset. So if this can be changed at the will of the supplier, at the call of the supplier, then we say that the lessor has SSR, substantive substitution right. And whenever there is an SSR, the asset is not identified, and if that particular asset, the particular contract will not be covered by Ind AS 116. Same example like in the case of this OneDrive case, OneDrive or Google Drive, whatever you use, cloud storage. Okay, for those of you who are using it on a paid basis. Now, for you cannot say, Google, you have to store this in only in my city, only in my town. Google will say nothing doing. I'll store it wherever, whichever place I want within India maybe. Okay, so if the vendor has substantive substitution right, whenever Google wants or whenever Microsoft wants, they will change the hard disk, they will change the server. That kind of right if the vendor has, then the asset is not identified, and when the asset is not identified, we say that the vendor has SSR and the asset is not identified, and whenever the asset is not identified, you cannot consider it to be a part of your lease contract. You will not do lease accounting. So then what will we do? Lessor will follow guidance under Ind AS 115, and the lessee, the customer, will account for it as a normal expense. So if these two conditions are fulfilled, we say that the So lessor has SSR and the asset is not identified. Now, cases when SSR does not exist. When do we say that the substantive substitution right does not exist? Now, one case where the substantive substitution right does not exist is if the contract says, for example, I will replace the car. The car was identified. The registration number is also mentioned. Everything is mentioned. But the contract says that the car will be replaced if, let us say, there is a vehicle breakdown. The vehicle has, got damaged. That is one thing. Or after a specified period of time, after 2 years, the vendor can change. Then SSR does not exist. Then SSR does not exist. And if the customer cannot determine, so I don't know whether the vendor has the ability or not. Generally, this does not happen in real life scenarios. Contract will mention explicitly. But if the customer says that I cannot determine, then the standard says assume that the SSR does not exist, right? So with this we have understood what is identified asset and what is substantive substitution right. If you have any questions so far, you can put it in the chat box and I'll take them up once I complete. Okay, and the next aspect of identified asset, whenever we say that the asset has to be identified, another important aspect is that the assets has to be, if it is physically distinct. So again, this flat number, this particular asset, this particular location, if it is physically distinct, it is identified. But a lot of time what happens is you cannot physically distinguish the asset that is the subject matter of contract. For example, if let us say we are talking about a storage tank, favorite example, storage tank, and let us say we have BPCL and we have Reliance. Okay, two companies. So for those of you who have not heard me or who are not aware of me, I forgot to introduce myself. It came to my mind when I typed BPCL here. So I'm Suraj and I qualified CA in 2009 and with all India ranks of course 1, 4 and 2. I'm also SEMA UK qualified. I have worked in Bharat Petroleum for close to 5 years. Then I worked in Trafigura, the world's second largest commodity trading company. There I have worked for another 2 years, and then since 2017 I have been teaching, right? Teaching students of financial reporting for CA, ACCA, CPA and CMA. Apart from this, discussing with you guys, I was also a part of the examiner team from 2012 or 13 till 2017 before I started teaching. So basically correcting papers and setting papers for a lot of students. I have experience of correcting over 2,500 copies. I understand what it goes in correction, how papers are corrected, how students write. So all those tips and tricks I would be sharing with you as we would be discussing these chapters. That is one thing. I have also written study material for Board of Studies, your strategic cost management and performance evaluation, chapter number 1 and chapter number 13, that is the case studies for the first edition, about 12 odd case studies I had written. I had written it because I used to write case studies for one of the institutes in UK. So that's where I got into this writing case study for ICI. Of course, now that will become a self-paced online module after November 23 attempt. But yes, if you have been reading that chapter 1 and chapter 13, that is what I had written. This came to my mind when I wrote BPCL, and a lot of examples and a lot of insights that you'll be getting would be based out of my work experience. So I've also worked in a commodity trading company, so I've worked a lot with derivatives, forward contracts, so that gives me a lot of experience in financial instruments handling, and because of that you will have a great amount of practical aspect also, even in this limited fast track process. I hope all of you would be able to benefit something or the other from this, right? So yeah, coming back to the example, so BPCL and Reliance, let us say Reliance has a storage tank, and what BPCL does is BPCL enters into a contract with Reliance and says, yes, I want to use 50% of the capacity. So whatever capacity the tank has, the storage tank has, we will use 50% of the capacity. So here there is a single tank. It is not physically distinct. There are no two tanks. We are saying it's a single tank. And what is the usage? The usage is 50%. Now in such cases, how do we decide that whether there is a whether the assets are physically distinct or not. Now, if what the standard says is, if the capacity represents the substantive or significantly all of the capacity of the asset, then you say it is physically distinct. So in these cases, the term we use is 90%. Whenever standards use substantially all, significantly all, a benchmark number is 90%. So if the contract is for 90%, we will say yes, there is a lease. Otherwise, we will say there is not a lease. Right? So that is when it comes to a identified asset. How do we understand? One more thing, students and friends, if you find that I am going slightly faster, please drop in a comment and let me know whether the speed is perfect or not. Accordingly, I can modify my speed so that you can understand it well. Is the speed fine or not, or are you finding it that it is quite fast or very slow? Whatever is your feedback, genuine feedback, you can just drop it down in the comment box. Thanks Sandesh. Sandesh says speed is well. Archana, thanks Archana, pace is perfect. Others, I need substantially all saying that yes sir, speed is perfect. We can continue. And as I told you today, I don't have a writing pad. Manoj also says fine. Rest all, I hope you have not slept. Okay. Yes, thanks Bhardwaj. Thanks Yashwant. Thanks Banu. Okay, Kalyan Kings, Nivedita, perfect. Ravi Teja, perfect. Thank you guys. Okay, so that gives some kind of comfort that yes, speed is perfect. Now, the next important part, and this is more for theory, okay, this concept that we are learning is more from a theoretical perspective, where we will be able to answer some questions where they ask whether the contract contains a lease or not. Now, the next aspect is right to control. Right to control means the customer, whenever I'm saying customer, I'm referring to the lessee. So why am I not saying lessee? I'm not saying lessee because till the time we establish that the contract is a lease, I cannot say there is a lessor and there is a lessee. So there is a customer and there is a supplier. If this conditions are met, then we can say yes, there is a lessor and there is a lessee. Okay. Now, another important aspect is right to control the leased asset. Now, what is this right to control? Right to control means, whenever I say right to control, what I am trying to say is, if I am the customer, I have the right to direct the use of the identified asset. And see these important key terms, no? You should note it down somewhere, because if at all there is a theoretical question where you have to give an explanation, then these keywords is what will fetch you marks. Okay. So right to direct the use. The customer will direct. If I have taken a car on lease, I will direct, or I will decide whether I have to take it on the road, whether I have to drive it, whether I have to not drive it, I will decide. But say for example, I have taken a car on lease and I start loading cargoes, goods, those heavy items onto the car, and I start damaging the car. In that case, the lessor, will he be happy? He will not be happy. He'll come back and he'll stop me. So I can use the asset within the terms and condition of the contract. That is what is called right to direct the use of what? Of the identified asset. So first thing, identify the asset. Second thing, the customer can right to direct the use. That is the second aspect. Okay. And the customer has right to obtain substantially all of the economic benefits from the use of the identified asset. Meaning to say, in the lease period, who will get the economic benefits? The lessee will get the economic benefits. From what? Very important. This a lot of you would have missed. From the use of an identified asset. So by using the asset, the customer will get substantially all of the economic benefits. Now here I would like to add one example, because this is a place where you need a absolute conceptual clarity. Okay, say for example, there is a building. Now for using the building, we pay rent. Okay. We pay rent. The lessee pays the lessor the rent. Who uses the building? Lessee uses the building. Sir, what will the lessee do? The lessee will carry out his business, his or her business. Okay. Now, if the lessee uses the building, the lessee should get the benefit of using the building. Okay. But the building also appreciates. That is, if I own the building, the value of the building goes up. So I get some benefit because of the ownership of the building. Now tell me, who should enjoy, or who has the right to enjoy the appreciation of value of the building? The lessor or the lessee? Is it the lessor or the lessee who has the right to get the building's appreciation? Who should enjoy it? Should the lessee enjoy it, or should the lessor enjoy it? If you can just tweak it, the lessor will enjoy. So, as you mentioned, lessor will enjoy. Here, the right to obtain substantially all of the economic benefits from the use of the asset will go to the lessee. From ownership of the asset, either will go to the lessor, or subsequently we'll understand if at all there is a finance lease and all of that, that will be with the lessee. And the right to direct the use of the identified asset. So I have the right to say, okay, how will I use the asset? Now, okay, if these two are satisfied, then we say there is a right to control. Now, what is the meaning of right to obtain substantially all of the economic benefits? By using the asset, by getting output, by producing the output, or by giving the asset on sublease to a third party. I have taken a, let us say, a premise on lease. In that premise, I run hostel. A lot of you will be staying at hostel. I have taken the premise on lease. I have started a hostel there, and those rooms I am giving it out on rent to others. So even by subletting, by using that building, I am getting the benefit, and hence there is a lease. Okay, so there could be subleasing, there could be sometimes byproducts, sometimes assets, primary output, most of the times goods and services. All of these are economic benefits, and those economic benefits should be attributed or should be enjoyed by the lessee. Now, just because the lessee can direct to use the asset, or just because you are able to use the hostel rooms, you will not have infinite rights. Otherwise, what will happen? The hostel occupants will start damaging the property. Okay, they may start doing some activities which are not allowed, gambling and all of that, gambling, betting, whatever it is. Okay, so supplier will have something called as protective clauses. Supplier will have something called as protective clauses. Now, what are these protective clauses? Just a second. What are these protective clauses? These protective clauses basically protect the supplier. So what is the meaning of protecting the supplier? They will say, you cannot carry out illegal activities in our hostel. You cannot get your friends, cannot stay back at night at your hostel, right? So all of those things are protective clauses. So for example, if it's a car, I've taken a car on lease. The supplier will say, you can drive it, but you cannot drive it in some specific states, or you cannot carry heavy goods in the car. So such kind of clauses are called what? Protective clauses. So within the condition of the contract, within the terms of the contract, we will say that yes, if the supplier has protective clauses, even within that area which is allowed in the contract, I should get the benefit. For example, if you are using a hostel room, so what is the benefit of hostel room? You can stay and you can study there, correct? You can stay and you can study there, you have a place to stay. So there, you are able to use it within the terms and conditions governed in the contract. Okay. Then, sometimes the customer may be required to pay something to a third party or to the supplier based on the output. We will come to this in variable consideration subsequently. Even if you have to make the payment for using the asset, for example, 1 rupee per kilometer, even if that kind of condition arises, even in that case, the customer can have or will have right to obtain substantially all of the benefits from using that particular asset. So to summarize, When we say right to direct the control, we say how and for what purpose the asset is used. If how and for what purpose the asset is used, who can decide? If the customer can decide, we say the customer has the right. If it is predetermined, and in that case, if the customer can use without supplier interference, or if the customer has designed the asset, even in these cases, we say that the control is with the customer. Not very important for us to go into detail, right? So I will not be covering this part in too much of detail because it will again create a confusion. But just to remember these two aspects, if the decision is with the customer, that is, the customer decides how to use the asset, for what purpose the asset is used, then we say that the rights are with the customer. The customer has the right to direct the identified asset, hence it will become a part of the lease. If this kind of right is predetermined means it is given in the contract. It is given in the contract that how and for what purpose the asset is used. So for example, it is given in the contract that the car that I will be hiring, I will use it in the state of, let us say, Maharashtra, and in the cities of, let us say, Mumbai and Pune only. So how the asset should be used, it is already defined. But then, can the supplier come and interfere my operation of the vehicle? If the answer to this is no, then I have the right. Meaning to say, between Mumbai and Pune, it is up to me whether I want to drive, whether I don't want to drive. All of that, it is my call. So then, in that case, I have the right to control. Or if I have designed the asset, if let us say it is not a car but it is a machinery, if I have designed the asset, even in that case, I have the right to direct and control the use. Now, sir, how do we know when the supplier has the right to direct? If the supplier can interfere when you are using the asset, or if the supplier says subsequently also on a day-to-day basis, this is how you should be using the asset, then there is the right is not with the customer and it will not be a part of the lease. So some of the rights as an example, if you want to understand. One, to change the output that is produced. So I will decide what output will be produced from the asset. Okay, so that is again a right that I have. Or when the output is produced, when will the output be produced? Who will produce the output? What time will we produce the output? Where the output is produced? Sir, but here supplier can have a restriction. It has to be a predetermined restriction that you can use the asset only in, let us say, state of Maharashtra, as I gave you an example. After that, in Mumbai and Pune, it is up to me. In Mumbai, whether I want to do it in Borivali or whether I want to do it in Thane, it is up to me. Or if I have put it in, let us say, in Chennai, whether I want to do it in T Nagar, whether I want to do it in Ningambakkam, it is up to me, right? So where I can decide whether to produce the output. This is a very weird kind of an example. That is, I have taken an asset on lease. I will not use the asset. Now the supplier cannot come and say, boss, you have taken the asset on lease, you should use the asset. No, it is up to me. I don't want to use the asset. I've just taken it. I'll just keep it in the garage. I'm incurring loss. It's up to me. But I'm not producing the output. And then how much to produce? What is the quantity of output to be produced? So even in that case, it is up to the supplier. Okay, it's up to the customer. The customer will decide that yes, whether I want to produce the output or not to produce the output, how much to produce, all of that will be decided by the customer. Okay. Any questions so far? You can just drop it in the chat box in a couple of minutes. Otherwise, we'll continue. If you have understood, you can say, yes, I have understood whatever you have taught so far, so that it gives me also clarity that yes, students are able to understand. See, when a teacher doesn't get a question back from the student, there are two things. I have taught exceptionally well, okay, or I have not taught well at all, so that student doesn't want to ask at all. So if you have understood, please just say yes, I have understood, so that I can continue further. Those of you have more free time, you can see something called educational material on Ind AS 116. If you have more time, I suggest you also read the questions given in this particular standard, because in this material, that will give you a good amount of clarity. Okay. And other thing what I would like to tell to all the students who are attending is, if at all you have time, so those of you writing in November 23, I know it will be slightly tight for you, but for others, if you have time, or even if you don't have time, make some time and start reading annual reports. I have been using annual reports in my classes in the last 3 years, right? Whether I teach CPA, whether I teach ACC, I take annual reports assistance, because that is when you will understand what is the practical application of this, right? And instead, of course, in the new syllabus, they have added annual reports and all extracts in the study material itself. But then I would suggest every one of you to have a look at the annual reports. So now, so far, if you see, we have not done objective scope, because that is a small thing. One thing for all of you, no need to bother too much about objective scope and all of that. That will do it at the end separately. Whether an arrangement contains a lease or not is what we have discussed broadly. Correct. The meaning of the lease identified asset, then the low value asset and all, I'll come to it subsequently. So we have covered what is lease, then whether an arrangement contains a lease, what is an identified asset. Now here are some examples I would like to quickly discuss with all of you. Like, just a second. So here, for example, in this case, customer enters into a 10-year contract with supplier ABC for the use of rolling stock specifically designed for customer XYZ. Now, rolling stock is basically your trains and all, the railway wagons and all of that. That is called rolling stock. Now, the rolling stock is designed to transport materials used in customer's production process and is not suitable for use by any other customer. The rolling stock is not explicitly specified in the contract. So we have understood it can be explicitly or implicitly specified. The contract does not explicitly say yes, it has to be rolling stock, but anybody else cannot use that rolling stock, which means it is designed specifically for customer XYZ. ABC owns only one rolling stock, hence we can say that it is an identified asset, right? If it is then comes to substantive substitution, right? We have already discussed this in detail. One thing what students get scared of this standard is this number of pages. So no need to worry. The core content can be summarized in whatever I have done here. So there's about 28 pages of theory. That's all. Remaining all are questions and illustrations. So this is also we have discussed. I'm just cross-checking if I have to share with you some example. This assets not physically distinct, please make a note, 90% criteria. Only then we can say there is a identified asset. If it is 65%, it is not an identified asset. Then we have discussed about right to control. Now here, let's have a look at this one. ABC enters into a contract with XYZ, which grants ABC exclusive rights to use a specific grain storage facility over a 5-year period in the months of May and June. So now the contract is designed in a way that in the entire 5-year period, only in May and June the customer can use. So can we say that here the customer has a right to direct the use? Yes. For May and June, for the period of the contract, the customer can direct the right to use. So it need not be a continuous period. It can be intermittent period. Intermittent periods meaning there can be breaks. But yes, even if there are breaks, in those 2 months, if the customer has right to direct, we'll say that the asset is identified and the customer controls the asset. Then we have understood about right to obtain substantially all of the economic benefits. So all of this we have discussed. So another important aspect of whether we say that the customer has right to use the asset or not, or right to direct the use of the asset, a very key criteria is, can I exclude or can I ask or do I have the right to ensure that nobody else can use that asset? So that also gives me the right to direct the use of that asset. So if I have taken a building on rent and that particular flat, that particular floor number, I have the right to use the building. I can prevent anybody else from using that particular asset. Okay, so as a follow-up for all of you. You will quickly go through the illustrations in the material. We have discussed examples very broadly. We have covered all the types of scenarios and examples. Now what you will do is, after the session is over, whenever you have free time, you will quickly understand the examples which are given in the study material. Just a second, let me see if there are any questions. Yeah, so Banu, so concepts, after the concepts, what problems to solve? For now, you just revise the illustrations or the examples given in the study material. Then once we start solving the questions, right, I will solve some questions in the class. Some questions I will discuss in the class, then I'll tell you, okay, this particular question, please practice at home. Okay, so that is how we will continue. Okay, chalo, everybody has understood. Thanks a lot. Then one question is there, sir, will the asset which were taken on lease by the lessee tested for impairment by the lessee? They will test ROU asset for impairment. So that we'll understand in Ind AS 36, impairment related concepts. So if the ROU asset is impaired, then we will test it for impairment. Now please understand, now what the next step that we are going to learn is accounting. Just a minute. Now we will have a framework of what we are going or how we are going to account for leases when it comes to the standard Ind AS 116. Okay. Now two things here. Those of you who have learned accounting standard 19, most of the things you have covered there, but there are specific aspects which you have not covered in 19. So you have to forget what you have learned in 19. Concepts you can retain, but the way to account for it, you have to forget what you have learned in accounting standard 19. Those of you who have already done Ind AS 116, for you it will be more like a revision, right? Now when it comes to the accounting aspect of leases, what we So when it comes to accounting aspect of leases, there are two parties, lessor and lessee. There are two parties, lessor and lessee. Lessor is the one who either owns the asset or who already controls the asset. Meaning to say, lessor may have also taken it on lease. We'll understand the concept of sublease subsequently. The lessee is the one who has the right to use the asset. So I'm using only right to use because now we have understood what is right to direct the use. So now I'll be using the short term called right to use. Lessor owns the asset, lessee has the right to use the particular asset. Okay. Now this standard, when you talk about accounting for leases, largely focuses on lessee. Most of the things that we learn will be from the point of view of the lessee. About 70% will be from the point of view of lessee and about 30% will be from the point of view of lessor. Now when it comes to lessee accounting or when it comes to leases, subsequently we will understand that there is a finance lease and then there is an operating lease. These are two classifications. Now one thing you have to keep in mind is that this classification of finance lease and operating lease is not relevant from the lessee's point of view. It is not relevant at all. So what do I mean by that? Whether it is a finance lease or whether it is an operating lease, accounting is the same. So once you know how to account for the lease in the books of lessee, finance or operating does not matter. Just take up the lease, how you understand, how you identify the asset, and then how you calculate all of those lease liabilities and all of that. For lessee, there is no distinction. For lessor, there is a distinction between a finance lease and operating lease. Now, identifying a finance lease is also very important from examination point of view, because sometimes there may be a question which says whether this is a finance lease or not, or whether this is an operating lease or not. Okay. Now, before we understand whether it is a finance lease or an operating lease, there are few terms that we need to be clear of. One is inception of the lease and commencement of the lease. So what is this inception? What is this commencement? Inception means the date of lease agreement or commitment to parties to the principal terms and conditions. So whenever we say inception, it is either the date of lease agreement, means the date on which we have signed the lease agreement, or the commitment by the parties to principal terms and conditions. We have not signed the lease agreement, but we have agreed broadly that yes, this will be the rental, this is the property. So that is what is called inception of the lease. Now, why is inception important? And inception is important because whether a contract contains a lease or not, we have to decide at the inception of the lease. So on the date of agreeing to the contract or on the date of signing the lease agreement, we will say whether the contract contains a lease or not. That is the first thing. Second, commencement. Commencement is the date on which the lessor makes an underlying asset available for use by the lessee. So the date from which I can use the asset is called commencement. Now, inception is important only for assessing whether the contract contains a lease or not. Commencement is important because from the commencement date, you will start accounting for lease related transaction. In most of the cases, the question will not confuse you between commencement and inception. They will just have a single date. But in some cases, it may be possible that the commencement is different and inception is different. And second is, the calculation of lease period will begin from the commencement date. So as I told you, in exam, most of the time you will have only the commencement date. You will not have the inception date. Okay. Now commencement is important because from the date of commencement you will do the accounting, and the lease period also begins on this date. So what is this lease period? The lease period, or the lease term we call, is the core of the accounting of leases. Why? Because the calculation of lease related accounting aspects, whatever we'll understand subsequently, the lease liability, the right of use asset, all of that is dependent on the commencement date. So this becomes very, very important. The lease term also becomes very, very important, and that is what we'll be understanding next. Now here, first three are easy and straightforward. The last one here is when students have a lot of doubt. So please pay 101% attention. After this, you should not have any confusion on lease term. Okay. So what is lease term? Lease term means, normally, I'll just show it to you in a contract. Normally, in a contract, they would say the contract is valid for 3 years. Okay. So whenever you look at a lease agreement, if you have not yet looked at a lease agreement, whenever next place when you go for audit, just take up any one lease agreement and say, please give me the lease agreement. Okay. Contract is valid for 3 years. That's the first thing. Now, this 3 year is not the lease term. What is the lease term? In this 3 year, what is the non-cancelable period? So what is the meaning of non-cancelable period? Non-cancelable period means in that period, the lessor or the lessee, both these parties, they will not be able to cancel the lease, or they will not be able to get out of the contract. So what happens if they come out of the contract? There will be significant penalties if they come out of the contract during the non-cancelable period. So normally these type of clauses are kept in office rentals and all of that, where both the lessor also wants that lessee will stay, and the lessee also wants certainty because they would have spent a lot of money in interiors and all of that. So I was working with one of the early companies I worked with. We spent about close to 60 crores just on interiors and setting up the office space. That is the amount you spend. Now when I'm spending so much of amount, I want to ensure that I will be allowed to stay in that premise for some specified period of time. Okay. So here, assume for a moment that contract is valid for 3 years and the non-cancelable period is 2 years. So meaning of non-cancelable means neither the lessee nor the lessor can come out of the contract. So what if they come out? You will have to pay penalties. So the non-cancelable period is the lease term. Now you will understand the logic of using the non-cancelable period when we start doing lessee and lessor accounting. Okay. So the non-cancelable period is 2-year period, which means just a second, yeah. Which means for a period of 2 years, there is a rent commitment. For a period of 2 years, there is rent commitment. And even in this 2-year period, if there are some rent-free period, let us say the supplier says, first 3 months I will not charge any rent, you set up all your interiors. After that, for the next 1 year and 9 months, we cannot cancel the contract. So, even if there is a rent-free period, that is included in lease term. Even if it's a rent-free period, it is included in lease term. Okay, that is one. Now, non-cancelable period is understood, rent-free period is understood. Now, after 2 years, what happens? After 2 years, what happens? Now, after 2 years, what we have to check is there an option to extend? So, does the lessee have the option to extend the lease? And now, when we say option, please remember, you would have learned the future and options in SFM also, right? When we say option, one party has the right, the other party has an obligation. So, if the lessee has the right, then the lessor has an obligation. So, when I say lessee has the option, the lessee has the right. The lessee says, I want to extend the contract. The lessor has to agree. And if there is an option to extend, which is reasonably certain, reasonably certain. If lessee has an option to extend which is reasonably certain, then we will say we will include in the lease term. Reasonably certain means what? The lessee after 2 years will say, I will exercise 1 year extension. Then the lessor cannot say no. And after it has been extended, then the lessee will include that in the lease term. Sir, why are we including that in the lease term? See, if I am a lessee, if I have spent a lot of money in creating that particular asset, in building that interiors and all of that, I would want to use maximum use of it. I would want to use, for example, I keep telling my students, the studio that we have built. Now, to build the studio, we have spent a lot of money. So, I want to use the studio for maximum period of time possible. So, if I want to use the studio for maximum period of time possible, I want to exercise this right to extend. And if this right to extend is reasonably certain that the lessee will exercise option to extend, and if it is reasonably certain, that period will be included in the lease. Now, the fourth one, which is the most confusing one for most of the students, that is option to terminate. So, what is this option to terminate? See, I have a non-cancelable period of, let us say, 2 years. Okay, but the contract is itself for 3 years. Right now, even in this non-cancelable period of 2 years, after 1.5 years, I can terminate. I have an option to terminate. And if I am likely to exercise the option to terminate, I will not include that in the lease term. Okay. So, if in the last 2 years, I have after 1.5 years, I can terminate. I have an option to terminate. And if I am likely to exercise that option, then it is called, or it is not included in the lease term. Now, some of you may have a doubt, sir, why will we put a clause which says after 1.5 years we can terminate the lessor? Why will the lessor agree, or why will the lessee agree? The lessee agrees to this kind of termination so that in case the asset does not perform as expected, we can come out of the contract. So, what happens in case of termination? Most of the cases, when there is termination, there will be some penalty. There will not be a significant penalty, but there will be some penalty. Think of it like your articleship period. First 3 years, in 3 years, first 1 year you have an option to terminate, right? If you are reasonably certain to exercise, from the date of termination, you will not consider it to be a lease period. But if you are not reasonably certain to terminate, if you will not terminate, then the entire 3 years becomes your articleship period. Same logic here also. So, first, non-cancelable period always included. Non-cancelable period always included. Rent-free period included. Option to extend if exercising is reasonably certain, yes. Option to terminate, if you are reasonably certain to exercise, then you will not include. Sir, but the lessee is not reasonably certain to exercise, then you will include. All of these put together becomes your lease term. Just a second, this I think the screen is stuck. Let me just reshare the screen. Then discussing about this non-cancelable period. So the question that we need to ask, or the way we need to check, is can the lessor or the lessee terminate the contract? If they can terminate, and if there is significant penalty, then it is an enforceable lease, and that will be the non-cancelable period. If penalty is not significantly involved, there is no penalty which is involved, the penalty is not significant, then it is not a non-cancelable period. Now normally, if I have to give you another example, what happens is, generally, say for example, generally what happens is, if say I have taken a property on lease, and by giving 1 month notice I can vacate the premise, then that is not an enforceable lease, because generally in the industry you can vacate a premise by giving 1 month notice. We have to see, by cancelling the contract, by coming out of the contract, is there a significant penalty? If yes, then that is a non-cancelable period. If there is no significant penalty, only 1 month rent that everybody pays, so that is not a non-cancelable period. Now for examination purpose, mostly they will tell you what is the cancelable period, what is the non-cancelable period, they will give you, or you will be able to understand, yes, there is an option to extend, reasonably certain, include. So this thing is what you have to highlight and keep in mind when you have to determine the lease term. Rent-free period, yes. Non-cancelable period, yes. Option to extend, reasonably certain, yes. Not certain, no. Option to terminate, reasonably certain, yes, no. Not certain, yes. All of this put together makes your lease term. Now, lease term always begins at the lease commencement date, and it extends till the end of the non-cancelable period. So whenever we say lease term, we are saying it begins at the lease commencement date. Then, if only the lessor has the right to terminate the lease, the period covered by the option is considered as non-cancelable. Now, here what you need to understand is, the lessor has the right to terminate, the lessee does not have. So the lessee has the obligation to continue to use that asset. In that case, when we say, when you have to account for it, the lessee will consider it to be a non-cancelable period, even the lessor will consider it to be a non-cancelable period. So why? Because the lessor will cancel only if it is beneficial to the lessor. Okay, the lessor will cancel only if it is beneficial to the lessor. So the lessor will not cancel if it is not beneficial. So if it is beneficial, he will get more benefit. So he can extend the non-cancelable period to the extent possible. Maximum period he will try to make it non-cancelable. Or if he gets more benefit, he will cancel and he will get another lessee. So even there, he is getting more benefit. So if the lessor has the right to terminate, you will always include that. Then if it is a non-continuous period, for example, 2 months in a year for 5 years, the lease term will be 10 months. Then option to extend and terminate is based on facts and circumstances and not based on past practice or intention. Okay. Then you can go through these We said if there is an option to extend which the lessee is reasonably certain to exercise, in that case we'll include it as a part of lease term, right? Now we have to carry out a reassessment of this reasonably certain aspect. That is, what can we consider whenever we say, for example, we said that the leased term, whenever we are reasonably certain to extend, we will include. Now, when do we reassess that reasonable certainty? We have to reassess when there is a significant change which has happened, which is within the control of the lessee, and it affects whether the lessee is reasonably certain to exercise or not to exercise the option to extend and terminate. I'll give a very simple example here. Say for example, I have taken a property on rent, and the business has grown, and because of which I have had more and more employees. Now the place is not sufficient. Now when the place is not sufficient, earlier I thought I will extend the term, but now I am thinking I will not extend the term. In that case, I will reassess the reasonable certainty, and subsequent accounting for this we'll understand when we understand the reassessment aspects. Then the entity should revise the lease term if there is a change in the non-cancelable period of the lease. Now what happens? For example, option to extend was not included. Initially, option to extend was not included. For example, 2 years we had, extension we did not consider. While calculating the lease term, option to extend was reasonably not certain. Now if the option to extend was reasonably not certain, like in this case what we can see here, it was reasonably certain, we'll include. If it is not reasonably certain, then we will not include. So initially we said that it is not reasonably certain. Now when we said it is not reasonably certain, subsequently lessee exercise that right. Subsequently the lessee exercise that right. Now when the subsequent lessee exercise that right, then what happens? Initially we said we did not include. Now I have exercised. I should include or not? I should definitely include. So if it was initially not included, but now it is included, now I have exercised that option, I should include that in the lease term. Similarly, if the option to terminate was initially included, but it was, we do not exercise it at a later date, we did not terminate it, so in that case also we will not consider that termination period. So basically, if these options, both of these options, to extend or to terminate, if they were considered in determining the lease period, but subsequently, initially we said we will not include it. Sorry, initially we said we will not extend, but now we have extended, revise the lease term. Initially we said we will terminate, we did not exercise the termination option, so in that case also we will revise the lease term, right? Now this gives us a broad aspect about lease term. More important, or the most important part here that you need to remember is this. What is the lease term? An option to extend, whether we'll include; an option to terminate, whether we'll include or exclude. Once you have an understanding of the lease term, we will move on to the next aspect where we will understand the accounting for the lessee, which is the most important part. So in the last 1 hour, we have just been understanding the conceptual part. Is there any doubt in whatever we have discussed so far, or are we good to go ahead with the conceptual understanding or accounting part of the problem? Any question, any doubt, please feel free to ask. Not just even now, subsequently you can ask, but if you have any fresh doubt now, it will be easy if you ask now, so that we can cover it immediately. And lease is such a standard where Big Fours and all, they created 1,000 pages of literature just on leases. So that is what is a huge aspect, if you ask me. Sir, will there be protective rights not prevent the right to use the asset? No, protective right does not prevent the use of the asset. The reason being, protective right is to protect the protective right is there to protect the interest of the supplier. See, I have a property or I have a car, or let's say you have a car. That is most easy way to understand. You have a car and you want to give it out on lease to somebody, or you have a bike, you want to give it to your friend. What will you say? Boss, you will wear a helmet, you will not drive wrong way, right? You will not exceed the speed limit, because if that happens, you will get a challan. Correct or not? So when you are saying all of this, I will try to ensure that my bike is protected. I don't get a challan. Don't drive wrong way. All of these are your protective right. Now, if that is your protective right, then it does not prevent the user to drive it properly. So if he's driving in the right lane, he will get the benefit out of it. Right? So that is what it is. The lecture will be available on YouTube till today, tomorrow, and then what we'll do is we'll compile entire Ind AS 116, and it will be uploaded in our final YouTube channel. So you can subscribe to our final YouTube channel. There it will be available for about 10 to 12 days. Important standards, I will retain it till the examination. So that part you can be assured of. So after the class, you can just subscribe. I'll send you the links. You can subscribe to the channel, and it will be available in that particular channel. Okay. I can't do a live on that channel because it doesn't have sufficient number of subscribers. So if you can get me 1000 subscribers, then we'll have live on that thing directly. Okay. Now coming back to the most important aspect of what we have to understand is the lessee accounting. Now here I am not going into too much of depth of concept, but I want you to understand few specific aspects which can be understood only logically. Okay, so please ensure that you understand, you follow whatever we are learning in terms of lease accounting, the framework part, and then subsequently we'll understand how to do the accounting for it. Now when we say lessee gets a right of using an asset. So we will account for something called as ROU asset. Then the lessee has a liability to pay lease payments, for which we'll account for it as a lease liability. Okay. These are the two components which you need to be aware of. ROU asset, lease liability. Now, two things. The way we calculate lease liability, the same concept we will use in financial instrument amortized cost method. So, please pay 101% attention to this topic. And though it is a simple one, I've seen a lot of students getting doubt as to, sir, how to calculate this. Okay, I'll give you a standard format. Just follow that format. It will be super easy for all of you. Right. So we have right of use asset and we have a lease liability. Now, whether it is a right of use asset for a finance lease or an operating lease, it does not change. It does not change, meaning it will remain the same. Sir, what is a ROU asset or lease liability? I've given this in a summarized manner here. Right of use asset. Right of use asset, the way you have to learn this table is, right of use asset is equal to 1, 2, 3, 4, 5. These are the 5 things. Right of use asset is equal to 1, 2, 3, 4, 5. Now, in the first thing, what you have is lease liability. So, right of use asset is a lease liability, is equal to lease liability plus minus something. So, first you have to calculate lease liability. So, what is this lease liability? Present value of lease payments. So another term we got introduced here, lease payments. Present value of lease payments to be paid discounted at rate implicit in the lease or incremental borrowing cost. Now, two things. To calculate the present value, I need the lease term, which we have already understood. To calculate the present value, I need the discount rate. Now, discount rate we are saying either it has to be rate implicit in the lease or incremental borrowing cost. Now, here a lot of students get confused. Sir, is this rate from the point of view of the lessee, from the point of view of the lessor? Whose rate are we talking about? Students, rate implicit in the lease is from the point of view of the lessor, and the incremental borrowing cost is from the point of view of the lessee. Now, the sentence what it says is, if the lessee knows that the lessor has or lessor is earning this rate of income or this rate of return, the interest rate implicit means what? Implied, calculated, correct? So if the lessee knows that the lessor is earning 10%, 11%, 12%, we will use that rate. But if the lessee doesn't know, in many cases the lessor will not tell all the trade secrets, right? So if the lessor does not know, if the lessee does not know, what will the lessee use? The lessee will use incremental borrowing cost. So what is this incremental borrowing cost? The incremental borrowing cost is the cost or the rate that you will incur to borrow similar amount of loan for similar kind of asset. Whatever is the rate you incur, that is called incremental borrowing cost. Sir, how do we identify how do we calculate implicit rate? This will not be tested in the examination, but just understand this. It is very, very important. Okay. Let us say I am putting here an amount or cash flow. Whenever I say 0, that is today, beginning. Whenever I say 0, that is today or beginning. Let me just share the screen. Whenever I say 0, it is beginning. Year, cash flow. Cash flow, let us say I have a car. I am a lessor, you are the lessee. The best way to understand. I am the lessor, you are the lessee. I have a car which has a present value of 5 lakhs. Present value or the fair value. I'll put it fair value. Fair value of 5 lakhs. This 5 lakhs of asset I am giving to you for using. So, I am transferring this 5 lakh of fair value of asset to you. So, it is an outflow for me. Sir, we are not paying money. Yes, I am giving you an asset worth 5 lakhs. So, it is a kind of outflow. Then, let us say the lease period is for 5 years. The lease period is for 5 years. Okay. Now, in each of these 5 years, you have agreed to pay me 120, 1 2, 3. Each year, you will pay me 120, 1 2, 3. These are fixed lease payments. What is included, what is excluded, we'll come to it separately. Understand the IRR concept here. A lot of students, they don't understand this concept. They just remember implicit rate of return, implicit rate of return. Understand this. This will be really helpful in your practical life. 120 each for a period of 5 years, and at the end of 5th year, I know that either I have agreed with you, you will pay me some amount, or I will sell it to a third party. And my estimate of the residual value of this asset is 50,000. So when I get back the asset from you after 5 years, it will be worth 50,000. Sir, what is this may be guaranteed, unguaranteed? We'll come to it. Just for now, think of it. I gave you an asset worth 5 lakhs. You gave me 1 lakh 20, 1 lakh 20, 1 lakh 20 for 5 years, and at the end of the lease term, you gave me 50,000. So total inflow for me is 170, right? Now what I have to do is, or what the lessor does is, lessor in his mind says, what is my return? IRR. Sir, why are we using Excel? We don't get Excel in the exams. You are not even required to calculate this in the exam. They will give it to you. IRR. So I'll just use the Excel thing, IRR, which gives me 9%. Now this 9% or whatever the number is, 8.95%. This is the implicit rate or the IRR that we refer to in the questions. Okay. Sir, does it include guaranteed value, unguaranteed value, all of that? I'll come to it when we discuss lease payments. For now, just think of it. I gave you a car worth 5 lakhs. You paid me 120, 120, 120, 120, and at the end you paid me 170. I made an income or I earned a rate of 8.95%. So you as a lessee, when you have to do the accounting for it, what you will do is present value calculated at the rate implicit or incremental borrowing cost. Period will be the lease term. That is the first part. So lease liability is equal to present value of lease payments to be paid or which will be paid discounted at rate implicit. Now please remember, in this I included 50,000 at the end. That you will not include in lease payments, okay, unless it is guaranteed. So that discussion we'll have separately. So lease liability, present value of lease payments which will be made in the future, discounted at IRR or incremental borrowing cost. If IRR is not known, implicit rate of return, then you will use incremental borrowing cost. So first component, lease liability. The first thing you will do, calculate lease liability. Plus, if we have made any advance payment, now if you have already made the payment, we can't call it a liability, but we have paid for it, right? If you have made any advance payment, that also will be added to right of use asset. Then, if we receive some incentive, so sometimes what happens is weird scenarios. I am staying in a particular office, I have rented a particular office. The office next door that is vacant, the owner comes and tells, or the office in the next building, the owner comes and tells, why don't you shift? We say if we shift, you have to incur shifting expenses, new interiors and all of that. the lessor says, the owner says, I will pay some amount to you. 50% of that I will bear. That is called lease incentive. Incentive to enter into the lease. That also will be reduced. So if the lessee is paying, you will add. If the lessee is receiving, you will reduce. Plus initial direct cost. So what is initial direct cost? Any other cost which is incurred to enter into the lease contract, documentation charges, legal fees, registration charges, whatever that is, that will also be included in right of use asset. And then lastly, present value of estimated dismantling and restoration cost. This is something which you would have learned in AS 10, we will learn in AS 16, that also will be included in the right of use asset. So come on, one last time, right of use asset is equal to lease liability, which is the present value of lease payments. Rate to be used is IRR or the incremental borrowing rate, plus advance lease payment minus any incentives received, plus initial direct cost, plus present value of estimated dismantling or restoration cost. Now, the same concept I will quickly apply in this example, what I have just mentioned here. Okay. Now, out of this, let us say lessee payment or lease payment for lessee. Lease payment for lessee is end of year 1, 2, 3, 4, 5. It is 120. Okay, 120 each. That 50,000 is not by the lessee. Okay, you are not paying that. You will have a present value factor at, now I'll use 8.95%, or for our understanding I'll make it 9%. Now here, how to save time? Take your calculator. 1 divided by 1.09. A lot of you will be masters in this, but still 1 divided by 1.09 equal to for 5 years. You just calculate and note this down. So is equal to 1 divided by 1.09. I'll be using Excel because I have that comfort here, to the power of 1. That's first time. So when you do the first time, you will get 9.17. Then once you press equal to one more time, like that you keep on doing, you'll get the present value factor. Present value is equal to 120 multiplied by this 110, 192, 96, all this put together, when you sum it, you will get 466,758. This 466,758 is nothing but your lease liability. And to this you will add, let us say IDC, initial direct cost of 10,000 is incurred, some stamp fees, registration charges and all of that. So my ROU asset will be 476,758. That is how I calculate the ROU asset. Yes, there are more complications. I am just giving you the initial concept, how to calculate ROU asset. Right. Now, because I have calculated lease liability, I will quickly give you the framework for lease liability, which we will be using in the subsequent problems. So lease liability always have year, opening balance, interest at IRR or incremental borrowing rate, payment, closing. This is the format you should be using when you are preparing the lease schedule. Now year 1, 2, 3, 4, 5. Now don't worry if you are not able to calculate at the speed of Excel, because I am using Excel for a purpose so that you understand how to calculate. I will be sharing this Excel link in the WhatsApp group that we have. So there also you can access it. And if you want to go back and revise, you can revise this. Okay. Opening balance of lease liability is 466,758. Interest rate at 9%. So this will be my interest expense. How to account for it, I'll come to it in next session. Payment is 120. Closing balance is opening balance plus interest minus payment 388,766. Subsequently, you can use calculator and get used to this. Then second year opening balance 388,766. Interest this multiplied by 9%, which is 34988. Payment 120. Closing balance 303. Like this, if we continue for 5 years, at the end of the 5th year, lease liability will become 0. This is called lease amortization schedule or lease liability amortization schedule. Very, very simple. if you follow this framework, if you follow this format, you will not forget anything in the class, right? Now, I know a lot of you would be interested to learn Excel also, because I keep on using a lot of Excel in my classes. If you are someone who wants to use Excel and get access to Excel, what you can do is you can use the coupon code Suraj, okay, and you can enroll for the Excel for free. So you will not be required, because you have attended the first day's live session. That is what special I can give it to all of you, because I started using Excel and I thought you should get benefit of that. So just use the coupon code Suraj. I have enabled 100. Okay, so you can use 100 for 100 students. After the session, you can get used to it. Very comprehensively covered Excel formulas and all, which will help you in your working life. Right. So with this, we'll conclude today's session. I hope the session has been useful. If you found it useful, please share it with your friends. Let others also know that there is something amazing which is available for you. And in this next, about 2 months of time, we'll get absolutely ready for the examination. That is what is the intention of what we are doing. Right. Do share it with your friends, and do give a comment that yes, tomorrow also you will attend. It is not for me, it is for you. Okay. I have to get up at 5, get ready at 5:30 and be available for the class. The class is for you. So drop a comment saying that yes, you will be attending tomorrow. And those of you who want to learn Excel, 100 coupon codes just now I have activated, SURAJ. You can just go ahead under upskilling. You can just enroll for the course. It's for free. And just because you have shown the commitment on the first day to turn up and attend the class. Any questions? I'm available for another 2-3 minutes on the live chat, and or more questions we can take up in either in the forum or in the next session. And if you have found this session useful, just let me know. Or if you want me to improve something else, sir, please include this, please let me know. Tomorrow onwards, it will be more of question solving from the examinations. Lessee accounting will perfect it. Thank you. That's a commitment I need. Great. And yes, one more thing. Some days, if I am not able to take class for whatever reason, I will communicate that a day in advance itself, so that you get to know that yes, tomorrow, the next day there is no class. But yes, this week the classes are there from Monday to Friday. Sometimes if I am unwell or if something else comes up, I'll let you know a day in advance, and we'll ensure we'll cover it subsequently. Not to worry about that. Okay, thanks a lot, guys, for the commitment and showing up, and we'll have a wonderful journey. Okay, and any feedback, anything, please let me know whether you have enjoyed the session. Yes, Archana, journal entry will come tomorrow. Everything we will not do, in a single day. If you add everything, it becomes very difficult. So today's follow-up task for all of you is to go back, revise the concepts, whatever you have learned so far, and complete the examples, illustrative examples given in the class, in the material, study material. If you have any doubt in those, you can ask. Okay. Chalo. Thanks a lot, guys. See you tomorrow. Have a great day. This live is immediately available. This link of live from wherever you have come, it is available. So you can just copy the thing and you can keep it. It will be there for 2 to 3 days. After that, it will be moved to our dedicated CA final channel. Okay. Thank you.